The best stochastic settings for a 15-minute stock chart is generally the 14 and a 3, with the settings of, in total, 14, 3, and 3. And these settings are going to offer you a good balance between sensitivity and reliability, helping traders identify overbought and oversold conditions, as well as potential reversals. But really, the ideal settings, it's going to depend on your strategy and your preferences. So obviously, it's important that you test and adjust them to fit your needs. So if you're thinking, what is the stochastic oscillator? It simply is a popular indicator. Traders use it to identify overbought and oversold conditions. It's a momentum oscillator as well. It compares the closing price of a security to its price range over a specific period of time. And there are two lines, the K and the D. And these fluctuate between the levels of 0 and 100. And the K line is the more sensitive of the two, and the D line is a moving average of the percent K. It's pretty versatile, but to get the most out of it, you got to understand the settings, how to optimize them, if that's your thing, for different time frames and strategies. So we're talking about stock trading. 15-minute charts for day trading is pretty popular. It actually provides a pretty good balance between the speed of price action and, of course, setups, and the quality of the actual trade signal. So in a 15-minute chart, you can identify short-term trends and those opportunities that you just may not see on a daily time frame. But trading on the 15-minute chart does require a higher level of precision, a higher level of speed, because those price movements can be pretty fast. So when we talk about the settings, we're just talking about the parameters that we use to calculate the oscillator, the number of periods, the smoothing factor, and the levels that you're going to use for overbought and oversold conditions. And these settings can have an impact on the performance of the oscillator and the signals that it generates. You use the wrong settings, you could be looking at some false signals, you can miss trading opportunities, and perhaps even larger losses. So the basic settings, again, 14 and 3. And we commonly use them because it's a pretty good starting point. Now the basic settings, they work by just comparing that closing price over a range of the last 14 periods. So we talk about oversold and overbought levels. Generally, they're 80 and 20. And when those lines cross above 80, we consider it to be overbought. It's a potential sell signal. When they cross below 20, it's considered oversold and a potential buy signal. And that all depends. Traders change those to 70-30, 60-40. It all depends on the trader. Now, the basic settings, they can be effective in trending markets. They identify overbought and oversold conditions pretty good, helps with setups. Can help identify potential reversal points, but they can also be used in range-bound markets, depending on the settings, and they can identify potential entry and exit points. But in volatile or choppy markets, it doesn't work out so good, like most indicators. So what are the advantages and disadvantages of the basic settings? Because it's really easy to try to over-optimize things. If you just use the default ones, it's simple. It's easy to use. Now, traders that often look for best settings, they only find the settings that fit for the current condition of the market. Curve fitting during optimization actually leaves traders with a trading strategy that's useless when the market changes. Now, the disadvantage of these settings, they could be limited in accuracy, potentially false signals happening. They're also affected by the market noise, false breakouts, a whole bunch of things. So to use it effectively, you got to understand the strengths, the weaknesses. Remember, that's a trading indicator that uses past price. So how would you find the best settings if that's the rabbit hole you want to go down? You got to test it. Experiment with the different settings to find the ones. So the default ones may not always be suitable for a 15-minute chart. Remember, there's no best settings. So you got to test and experiment with the different settings and how they fit your trading style and your time frame and your trading strategy. And when you test and experiment with the different settings, you will identify the ones that work best for you. So if you're testing it, if that's the rabbit hole you're going down, start with the default ones just to get a feel for how that indicator works. It's a pretty decent starting point. And when you test the settings, try different periods, different smoothing factors. So you could try a shorter period, like a 10 instead of a 14, or a longer period, like a 20, to see how it affects the signals. Those overbought and oversold levels at 80-20, they may not be suitable for the 15-minute chart and your strategy. So try adjusting those. Combine it with other indicators like moving averages. You got to backtest it, see how the different settings work over time, test those results, and that's going to help you identify the best settings for you. And here's an example of different settings and the results on a 15-minute chart. If you look at the 8 and 3, obviously you get more signals going on, but you get a lot of false signals when the market's volatile. The 20 and 5, it's moderate. It's a bit more reliable. It's going to be slower to respond, though, to price movements. At the 30 and 10, that's less frequent. It's really smooth. You can see that. But it's going to be less sensitive to the shorter time frame changes in price. So here's a strategy. I'm going to use my favorite setting. It's 8, 3, and 3. I've used that forever. It's a 15-minute stock chart. I'm going to use a 20-period simple moving average, and we're going to use standard trend lines. So here we have price in a bearish trend. We can see that by the price action. We can see that by the slope of the moving average. So that first trade has the stochastics overbought, price pulled back into the moving averages, and a former support zone that could act as resistance. The trade entry is just a hook of the indicator when the candle closes. In the middle, price is pulled back into resistance and it fell. But the issue is the indicator is almost right in the middle of those extreme values. So market price confirms the indicator being in a range pattern. It's not at a turning. We then get price being oversold on momentum candlesticks. Price is also extended from the moving average. That points to a potential mean reversion setup. We can see the support line of the channel is broken, but a reversal candle brings price back up over that bottom trend line channel. You combine that with a hook of the stochastics, it's actually a really great setup for a counter trend trade and a potential bullish trend forming. It just depends on what happens when the next pullback happens. The best practices, bottom line, if you want to maximize how effective it is, use it in combination with other analysis tools. Remember, oversold and overbought levels, they don't always mean we're going to see a reversal. So what else could we do? Make sure you use other indicators. There's so many out there, but keep it simple. Moving averages, you can use price patterns, trend lines, support and resistance levels. Your trading platform is going to have different options, including the slow stochastics. Uses a different formula than the fast one. The common mistake is relying just on the default settings without testing and experimenting with different settings or other indicators, because it's not a standalone indicator. You got to put other technical factors into it. And when the market's choppy or volatile, step aside. So we covered the importance of it. We covered the oversold and overbought conditions. That doesn't always mean reversal. There's advantages of using the 15-minute chart. It's faster. The basic settings, it's simpler. Talk about the best practices. You follow these guidelines, you could optimize the signals. You could improve your trading performance on that 15-minute chart. But remember, trading, it's a continuous learning process. You can't be afraid to test. You can't be afraid to experiment with different settings and different strategies to find what works best for you. And with that right tools, the right mindset, the right strategy, you could actually achieve those trading goals. We're talking about trading. We're talking about indicators. Try something a little bit different here. This is the ultimate guide to price pattern trading. It's absolutely free. The link is to the left. It's actually our most popular giveaway we've ever had. Indicators are great, but when you can add in price patterns, it makes it a whole lot better. Free guide. Download it. Talk to you soon.